Alrighty, folks, we are bringing you a super special and first time opportunity to interact with a 10-year Wall Street veteran. I call him a friend. He's been on the channel a bunch. Taylor from Life Goal Investments. How you doing, buddy?
I'm doing great. I thought I was your little brother, though. Isn't that what your mom says?
That's what my mother says. Yes, my mother has referred to you as my younger brother. I appreciate that. Thank you for the reminder that I'm so much older than you. I appreciate that.
Exactly.
Oh, that's awesome. Well, Taylor, do me a favor. Not everybody in school has had the opportunity to watch our videos together. Why don't you give a quick resume on who is Taylor? What have you done in Wall Street? What are you doing now? And then we'll get into the topics in hand.
Yep. Yeah. So I graduated college, went immediately to work on Wall Street in a role that's interesting because no one knows it exists. It's like a ninja behind the scenes. It's called an advisor consultant. And essentially, you go to work at the big asset management firms. So, like my brother worked for BlackRock. He had the same role I did, which is literally the largest. I worked for a company called Franklin Templeton for the bulk of my career, which managed like 4 trillion or something like that. And so, kind of, your roles are split dual fold. Half the days you sit with the portfolio managers that design the mutual funds, ETFs, separately managed accounts, hedge funds, and see how that portfolio construction process works. The other half of your day, you are a financial advisor to financial advisors, which is kind of a crazy thought. And the reason it's needed is because to be a financial advisor in the US, man, the bar is pretty darn low. You have to have a high school diploma and pass a test that takes a month to study for. And then you can go out and run Mike Zuber's money for the rest of your life. You're qualified. Like
Gary.
that's a crazy thought, right? And so a lot of people, when they're in that scenario, they realize that and they fly in a nerd. When a family brings them a million, 5, 10, 100+ million dollars, they fly in the nerd on the back end to construct the portfolio. And that's where I came in. So I was that nerd and did that for 12 years. I have 8 years in a formal financial classroom, which is why they trusted me to do so. And then we broke off and launched Life Goal. And I started doing social media work, which I had never had a social media account before in my life. That's not fair. I had a Facebook account back in college, but I didn't know what Instagram was. I didn't know what TikTok was. And I started firing videos out. And like everybody else that starts firing videos out, they fell on the face for the better part of a year. And then I started to kind of hit my groove a little bit. And now, thankfully, people enjoy watching what we put out. So I put out commentary every day. And then the other side of our business is we now run Life Goal Wealth Advisors, which is a financial advisory firm where we manage money on the behalves of high net worth individuals. So more than you wanted, Michael. There you go.
Well, let's talk about one more thing before we get into the topics at hand, because I think it's important. It's actually why you and I connected. You reached out to me cold. I want to call that 2.5 years ago, maybe 3 years ago. Basically saying, hey, I like what you're doing at one rental at a time. I see you have a diverse list of millionaires. Would you want to add a Wall Street veteran? Of course, I get cold emails like that all the time. I very rarely respond, and I very rarely invite them on the show. Yours got through. It was different. It was enough. You were authentic, and we had that first conversation. Right. I give lots of people one shot; they never come back. Your story to me that really clicked was when you were on Wall Street for 12 years. You were working with the top 1% of the 1%, right? The wealthy families. And what I heard from you and have come to believe is you wanted to take that experience of portfolio construction and bring it to the masses, which is in my words, not yours, what your vision with you and your brother's vision were at Life Goal Investment. So talk about that kind of journey. Because again, it's definitely a mission. It'd probably be a lot easier just to work with the top, I don't know, 1,000 families in the world. But you really are bringing it to the masses. And I think that's why you've blown up on Instagram and TikTok.
Yeah, thanks. It's fun. I come from the background. My mother's a statistics professor, and so the education is something that's kind of like born into me a little bit. That's what gets me going. Like if I can create take a complex topic and break it down in a way that all of a sudden people actually understand why Silicon Valley Bank blew up. That was one of the first videos that we had that went like really ultra viral, at least to the extent that we have the ability. It's 3 something million views. It was this kind of black box. Go ahead.
Right. No, I was 3 million views. That's awesome.
Yeah, and that was the first one that really kind of went big. But it was this complex thought of, okay, these banks are mismanaging what they do. I thought a bank just took money in and then lent it back out and back and forth. There's a lot more that goes on behind the scenes. So the ability to kind of break it down was, I think, in a way that anybody can understand, I think is why it caught on. And then I kind of consistently try to do that over time. And hopefully, when I explain how banks work, how the Federal Reserve works, and then at the end of the day, we take all of those kind of now fundamental skills that we've built with our underlying followership and say, okay, if you now understand how these pieces work together and how the economy functions based on all these underlying levers, now how do you invest with all this information and knowledge that you now have? And that's kind of the overall soup that we're trying to create with what we do at Life Goal.
Folks, remember, because you are a part of school, you have the opportunity to ask questions of Taylor or myself if you would like. You have two ways to do that. You can go below to the reactions button, click on that. There's a raise hands if you're brave enough to ask your question live, or if you're more comfortable, you can just type it in the comments or the chat box, the chat box, and I will read them. Again, folks, I'm the first person to raise a hand or put comments gets their questions asked. That's how I roll. So again, raise your hand, put comments in, and we will go from there. But Taylor, okay, now for the topics at hand. As somebody on Wall Street, who's been on Wall Street for 12 years, now running Life Goal Investments, there was a presidential candidate who announced taxing unrealized gains. I don't think there's any question, given our growing and ballooning national debt, that one of the solutions is going to be somehow, some way raising taxes. We got to pay for this thing somehow. One of the proposals was taxing unrealized gains. I think that would have a gargantuan effect on Wall Street companies. But I've never done it. So I thought I'd ask you, tell me about taxing unrealized gains.
It just disincentivizes investing, right? I mean, I'm not saying that it makes it so there's no gain to be made from investing, but relative to where we are right now, it is a less advantageous environment if you don't even sell an underlying holding. And yet at the end of the year, the government says, okay, because the stock moved from X price to Y price, you owe us. And it's like, well, no, I actually didn't physically gain that wealth. Yeah, but on paper you did. That's what they're saying. And so it creates kind of Pandora's box of problems. So there are other countries in Europe. We have a client based in Europe, and he has a private company holding.
Mm.
So he had to submit to his local government to say, hey, this private company that I have, I can't pay unrealized gains on it because I can't sell a portion of it because it doesn't price on a day-to-day basis. It's an illiquid investment. How do you tax that?
Mm.
And so then they absolved that of the unrealized gain process that he was going to have to pay. So all of a sudden, then it's like, okay, what is it that gets taxed? What is it that doesn't get taxed? If you're in a partnership with someone, what percentage do you own? Is it clear? Is it vague? How do you tax each one of you individually? All in all, it is definitely a disincentivizing measure to have people invest and grow companies, which drives our economy and drives us, currently being the US, being the greatest investable environment of anywhere on planet Earth. And that's why you've seen our markets do so much better, because there are so many things that happen overseas that are things just like this that disincentivize people to go ahead and fork out their hard earned money to
Mm.
allow a company to take that, nourish themselves, and grow further so everyone can reap the benefit on the back end.
Yeah, when I saw this, the thing that I always go to is the unintended consequences. It's funny. I love how you kind of talk about the investment side. Where I went to as the guy that's opportunistic and always looking for the deal was, this is going to create thousands of forced sellers.
Yep.
Because
Yep.
again, when you are necessarily a small business owner, maybe you own a small real estate portfolio, whatever it is, you're generally speaking asset rich and cash poor.
Yep.
That's how most of them roll, right? And if you suddenly get $1 million tax bill or whatever, and you've never even seen $1 million, you're going to be a forced seller of something. and that doesn't generally lead to great prices.
And that's interesting because I'd like to hear your take on this because at the end of the day, you look at this and say, all right, well, on someone on your side of the shoes, I know a lot of people on the real estate side say, listen, buy a home, get some equity in it, refinance, buy your next home and buy your next home and refinance and kind of leverage one home into the next. How does that work for that person?
Yeah, it's messy. Again, we'll have to set up some limits. Hey, Stacy, thanks. I actually had my camera off. I don't know what happened there, but thank you for pointing that out. I'm now, hopefully you can see me. Um, yeah, it's really scary because again, one of the plays, I mean, Ben Mala is a great example in the real estate space. Ben Mala, if you don't know who he is, he started from nothing, right? Kind of a one rental at a time story. He's now big into hotels, retails. But how did he get there? It's the 1031 exchange. He's
Yep.
always laddering up.
Yep.
And um he would become a forced seller. I really think about the small mom and pop small business, like a small grocery store or a small retailer or a laundromat or car washes. And they've built this over decades. And, maybe they own the land in the building that they operate in. And suddenly they got to sell something, right? Do they sell the land? Do they sell the business? You know, you don't want to create forced sellers. Not everybody is Elon Musk who can go borrow against his equity in Tesla stock, right?
Correct.
I completely understand that logic. I mean, that's an example of, hey, Elon could just borrow money and never pay taxes on his Tesla shares. Well, maybe tax that behavior. Maybe tax the borrowing of money against.
Oh,
There
I'm
you go.
100%. I'm
Yeah,
100% on board with that.
yeah.
100% on board with that.
I think it's a wonderful way to go after the top 100 people who are playing the game of just borrowing against shares, which is
But
non-taxable.
that's literally tax. I mean, like, if you look at this and you don't know the rules of tax, you look at that and you're like, that's tax evasion. Like it's legal tax evasion, but they're
Yes, legal.
literally taking
Yeah, yeah,
it's totally legal, don't get me wrong, but this is a way of them generating an income that we all have to pay taxes on our
yeah,
income,
of
but they
course.
do not because it's essentially
It's debt.
borrowed as opposed
It's
to
debt.
correct.
Yeah. It's
Correct.
asset-backed debt. I think
Yeah,
I
and the
think
problem
yeah, go ahead.
I was just going to say the problem with all of these hypothetical policies
Mm,
is that there's no brass tacks behind them. The detail isn't there yet, right?
yeah,
So in reality, it's probably going to have to be some sort of a publicly traded security that they can price, that they can actually get a tangible dollar amount at the end of the year that says, hey, you bought your cost basis here, you're now at this. That's the gain that you're going to have to pay the discrepancy on. Because
yeah,
again, like the foreign government that I was talked about, that private investment, they literally just absolved him and he had a massive embedded gain on that
mm,
private. It wasn't perfectly ascertainable as to what the gain was. And
but it
also,
was
he wasn't
something,
able
yeah,
to sell some down, to your point.
yeah,
He would have been a forced seller of something that he didn't really even have the ability to sell at the time.
yeah, pretty crazy. The last thing I'll say about unrealized gains is when I look at I think the Constitution, it's not allowable, right? There's uh,
I didn't
income
realize
tax.
that.
Yeah, and again, I did talk to one constitutional lawyer, I don't know, 6 months ago when I heard this, and he's like, "It'll never pass the Supreme Court, just like student loan forgiveness would kill it."
Yep.
So again, it's kind of a no-brainer. But again, I wouldn't mind a tax on people who play the game like Elon Musk, where you're getting debt on shares, because that's you and I got to pay taxes on that because we can't borrow. We got to sell the shares. But all right, let's move on to something else. Let's talk about the Fed cutting 50 last week. We didn't talk ahead of time. I'm curious, were you surprised? I think Wall Street was surprised. I think the betting market had it about 66%, 25. So Wall Street might have been offsides. What did you think?
I was surprised. I thought it was the right thing to do. I didn't think they would do it
Oh,
because
that's
they
a
were
nice twist.
they were very overt in their last meeting and their last press conference that, hey, we haven't talked about 50. And when you heard him afterwards, he got asked specifically, like, listen, was it the July report that essentially showed that over the past year there was actually 818,000 jobs that were not created?
Gone, vanished, vamoose.
And he said, yeah, actually, it was
Yeah,
that. And he didn't say
yeah,
that so bluntly, but at the end of the day, that's what he said.
yeah. I
Um,
think so too.
it was funny that he's now overtly also saying we got to take a grain of salt in what we think out of the jobs number that are coming out of the government. He's like, we don't trust them either.
Yeah, it's funny when I parsed what he said and I kind of back in the napkin math on the 818. Basically, what I think he said without saying it is, we're going to take any number they produce and whack it by 75,000. We're just going to
Exactly.
auto reduce by 75,000.
Exactly. Exactly. It's crazy.
Uh,
The very interesting one in the meeting to me that he did not take on, and he did puke on himself, in my opinion, was when they said, okay, you talked a lot about long and variable lags as you raised interest rates.
Mm.
And now, do we anticipate long and variable lags to the cutting process? And he just didn't really say anything. And the reality is, like, listen, the unemployment trend it's pretty consistently higher right now.
Yeah.
And so if we think that interest rate cuts immediately can stop that, like that's not a logical thought. And if you look at history, it doesn't prove out at all.
Yeah.
And so now my question is like, listen, all right. So do we anticipate unemployment going higher from here? And what does the Fed think about that?
Yeah. So actually, you put out a post again, folks. If you're not following Taylor on his Instagram, Life Goal Investments, you are truly missing out. Your latest video, Federal Reserve's forecast for unemployment is idiotic. All right. I think their forecast was what, 4.4 by the end of the year? Was that what it was?
Correct. 4.4. So listen, this is the shape. So I make it very clear in that video that there is a clear U-shaped pattern that's playing
Yep.
out. So it came down through 2023 or late 2022 and in 23, it bottomed and now it's moving up consistently. So it's creating this U-shaped pattern after being super high and coming down out of COVID. That
Yep.
U-shaped pattern on the bottom. Now the Fed is saying, okay, at the end of the year, we're going to go from currently at 4.2 to 4.4. So it's going to go up a little bit more. And then it's going to perfectly flatline throughout 2025 at the end of 2024, or at the end of 2025, rather next year, it'll be at 4.4. And then it's going to tick down to 4.3 and 4.2 in the subsequent 26 and 27. And it's like, okay, guys, listen, we just went through this massive rate hiking cycle. And you don't think that there's any lagged impact. We got a Titanic you're trying to turn around right now. And you think coming to this game late that you're able to cut now aggressively enough to have that change directions. And I go through history and I show every one of the prior, however many, recessions that we've seen saw this come down of unemployment, U-shaped pattern. And then not only does it not stop going up, or tick back down as the Fed, it hockey sticks.
Yeah.
And
it takes the elevator up and we take the stairs down. Yeah.
Correct.
So let me ask you this question. So it sounds like, and I agree with you, I think 4.4 is comical, certainly in 2025. But if I were to ask you, Taylor, what do you think the chances, if I gave you the number 5% sometime in 2025, would you take the over or the under?
Over.
Wow, you're going to go over.
Yep. History just said, I mean, again, I like to be optimistic, but I like to be realistic. I would rather be realistic. And if you look back again, watch that video. That video shows very clearly stated that it is not easy to turn around a train that is moving upwards of unemployment. It's like the Titanic. Reversing it is not an easy thing to do. And it's not, right now we're at 4.2. That is low historically on unemployment. So don't let me make it sound like we're in shambles from an economic position right now.
I mean, 5% was full employment, for the last 5 years or whatever. So again, getting back to 5 is not, I mean, it's millions of jobs lost, don't get me wrong, but it's not the world is ending. It's not China with 18.8% youth unemployment, right? It's
correct. And it's all about rate of change. Like people want to, 4.2 is low. It is low. But it's all about the rate of change. The direction is not moving the right way.
Well, you said over on 5, so that just I want to figure out where we're going on that. You think we can see 6?
I knew you're gonna do this. You're such a monkey. You're gonna peg me on something, aren't you?
Okay, well, last one. Do you think we see a 6 handle in 2025?
No, I mean, would I be absolutely shocked if it got there? Not necessarily, but I don't think so. I mean, it would
that
take
would be a lot.
It would take a meaningful degradation in our employment picture than what we're seeing right now.
Okay. So somewhere between 5 and 6, I would be right there with you. I think 6 is just too much too fast, I think. So But now I think the conversation goes to what are we going to do in November, right? We have an election on Tuesday and Fed meeting on Wednesday. Uh, I've already come out and told my audience, I think they're just going to do 50 again. We've had, I think it was Bostic this morning. It might have been Neil Kashkari saying, we got a lot of room to cut. We need to be aggressive, yada, yada, yada. I'm going 50 in November. What do you think?
I tend to agree. And for the record, I would have said at the beginning, I think I did say with you at the beginning of this year, the way data was playing out, especially in Q1, where inflation looked to be reverberating back up, I
Yep, I
said no
remember.
cuts this year.
Yep,
And then coming into the summer, I said, like, listen, you can't be an idiot. Like, you can't put your head in the sand. You got to pay attention to what the data says. And I
right.
said, listen, I think that it makes sense for them to cut now. I think that they're behind the curve, right? I think
Yeah.
that inflation is pretty clearly trending downwards.
Hmm.
And with that, I mean, you've had now last week was an anomaly, right? Last week you had commodity prices pop, oil
Hmm.
popped, and broad commodity prices popped, copper, et
Sure.
cetera. But more generally speaking, they have fallen off a cliff over the past 2-3 months. And so that's the input cost to everything. When the underlying raw material cost is coming off, it shows a lack of demand. And so that's been trending downwards. You've had bond yields crashing, cratering. I mean,
Yeah.
maybe that's an extension of what a word I should use, but nonetheless, they've come down precipitously.
Yeah,
That's
have
not
you but
necessarily
so let's talk about that for a second, because again, bond yields were coming down. They came down about 60 basis points, hence a 50 basis point move was warranted. But since Wednesday, they're up, and I checked before our call, they're up again today.
yeah,
What the heck is
yeah,
going on?
yeah. So people are. We got questions on. Listen, why have we seen a cut in interest rates? And since the cut of interest rates, why are mortgage rates
Up.
leaking back up? Yeah. And so I did a video on this, and this is another one where it was like an educational thing. It's like, listen, when you think about mortgage rates are based off of the 10-year treasury
Correct.
predominantly. Like if you had to pick one spot, it's the 10-year treasury. And so the 10-year treasury yield plus a spread, which is predicated on the person's level of risk, is going to get
Mhm,
you where you are. So right now, the 10-year treasury yields 3.7 plus
mhm,
a 2.5% spread or something to get you to 6.15. Um, but what people think is okay, when the Fed cuts, the 10-year moves. It doesn't. So the Federal Reserve controls the front end of the
mhm.
yield curve,
Yep.
meaning probably out to about 2 years. So they control the overnight, which impacts out to about the 2-year treasury yield. So as they cut, the front end 2-year will drop, right? The back end of the curve, call it 5, 10, 15, 20, 30 years out, is predicated on the future inflation expectation out of the market. So if the market sees a bigger cut on the front end than they expected by the Fed, they didn't cut 25, they cut 50, that leaves room for inflation to potentially tick up more than was already expected, therefore pressing the 10-year up, therefore pressing up mortgage rates. And so
Yeah.
that's kind of the iteration of how that whole system plays out.
No, I totally get it. Totally agree. Again, and the last thing I'll say on that is I've shared with my audience, the spread is still historically large. It did
It is.
balloon out to 310 basis points or 307, I think was the peak. It's now at 260. Historical long run average is at 180. So
Yep.
we still have some room for that spread to come in.
And
Let's
maybe you
go
have
ahead.
more insight to this than I do, but I think what's going to play out here is it will continue to contract as we get more clarity onto the direction of inflation. Is that fair assessment?
Well, I think it's two things. I think one of the reasons we've had an expansion was nobody knew how high the Fed was going. They've obviously now started a rate cutting cycle. We are in an environment where banks need to generate income, and doing loans is one way to do that. So I think the banks are going to start collapsing the spread because they know cuts are coming, and they need to generate business to clean up their broken balance sheet. So it would not shock me if we're down to say 200 to 220 by summer of next year. I don't think this is quick. I don't think this is sudden. I just think it's a slow, gradual, you know,
Yeah, they're
compression.
pricing risk. The banks are pricing risk. And the risk to them is inflation and reverberation back upward because that's their input cost. And then they land on the long end.
Yeah. Well, you know what? Let's do something for my audience here. One of the things, again, in your career, 10, 12, 12 years on Wall Street, you created life goal investments to do this. So my audience, why don't we talk about portfolio construction? Just talk about the parts that people should consider. One of the things that you and I talked about for years is you should have a commodity exposure. Gold's been ripping. I think it's at an all-time high. Unless you adjust for inflation, then it's not. But why don't you just talk about portfolio construction? Because I know that's something you like to nerd out on.
Certainly. That's been my entire career, literally. So my entire career has been building the knowledge base as to how do you construct a portfolio. So a lot of people that come to us and they say, "Hey," and I know this is a real estate channel, but I'll
Yeah,
talk about kind of the public investment side to
sure.
start. And they'll say, "Hey, I own stocks and I own cash. So cash are my buffers against, stocks going down in price." And I look at that and I say, "Okay, let's think about how this plays out now. What's the big risk to owning stocks?" I would argue that a recession is the big risk, right? If economies contract, corporate earnings are going to contract, stock prices are going to come down. And that
Mhm.
happens throughout history. All right. So now let's think about what cash does during a recession. Well, cash really doesn't do anything. It just treads water. And now, kind of next iteration is, and that's good, right? So cash isn't losing you money as your stock prices are going down. But let's think about what the Federal Reserve does when we enter a recession. They're going to cut interest rates. And so cash, the yield paid on a high yield savings account is going to come down. So that's that. But reality is the other asset class that has direct impact positively when they cut interest rates are bonds. Bonds are inversely correlated with interest rates. So as the Fed cuts interest rates, it drives bond prices higher. So I always say to people like, listen, if you're owning stocks on one side and you need a babysitter for them because they're the highest risk asset class and can produce the most downside in the portfolio, what's on the other side? Is it cash or is it bonds? Make the argument that I think it should be bonds, right? And I'll give you an example. So 2008, the S&P goes down 37%. It was actually down 49 peak to trough, but 37% is where it ends the year. Now let's look at the Treasury. So the Treasury, the short-term Treasury, 3-month, that's essentially cash. The 3-month Treasury bill was up 1.37% that year.
Hmm.
So it treaded water. The 10-year Treasury, the intermediate part of the curve, was up 20.4%. The 30-year Treasury was up 34%.
Hmm.
So even when you're thinking about owning bonds, not all bonds are created equal. So you have to understand the interest rate sensitivity of the bond and what does the best job of offsetting the risk on the other side. And then the third leg of the stool is, okay, in a year like 2022, when interest rates rip higher and the Federal Reserve yanks interest rates higher and stocks and bonds both take it on the chin, what do you hold as the third leg of the stool to help hold up in that environment? Michael, you're going to love this. You own real estate. That's a great hard asset that typically can appreciate in value because you raise rents with inflation. You own farmland, timber forests, gold, oil, all of those hard, tangible, commodity like assets that you can put your hands on is what people fly to in an inflationary environment that can put a struggle on the other two pieces of the portfolio. So let me round it out with this and then you can fire any question you want. The reality is, what you have to understand is when you're building a portfolio, you must build it like you're the GM of an NFL football team. And what I mean by that is you can't put the best player, Tom Brady, best player ever, you can't put 11 of them on the field because when the wind shifts the wrong direction, Tom Brady's hurt and your team doesn't even have a player to get out there. You need big linemen up front that have a certain job. You need wide receivers that are fast, running backs that are tough, quarterbacks, defensemen, all of it. Every single position on the field has to be accounted for and play a role because it's all a concert and they need to work together and sound good at the end of the day.
Yeah, this is one of the things that again I didn't appreciate till you and I started talking years ago was the purposeful construction of a portfolio, right? Thinking of where you are in life, where you want to go in life, risk tolerance, growth, all of those things. It's these are these are discussions that you really have to have it with a professional. And kind of to your earlier point when you started, just because somebody's got some fancy certificate on the wall, that doesn't mean they're qualified. A high school diploma and a 1-month test. Are you freaking kidding me? That's not what I
You got
want.
you got the big name of the firm on front, and they're like, "Look who I work for." And I'm like, "I
Yeah.
don't give a shit who you work for.
Yeah.
What's the diploma behind you say?"
Yeah, exactly. There are different levels to this thing. So yeah,
Yeah.
portfolio construction is something. And again, I look to you as the guy that sat in rooms and was around people that I'll never meet, right? The top 1% of the 1%. And if these are the conversations they're having, it's probably things that, the average Joe should think about. And that's what life goal investment does, is gives us a fighting chance to have those discussions. So I got a lot more topics, but since we're here, if somebody wanted to reach out to you and set up a phone call or discussion, how do they do that?
Yeah, yeah. So look us up on Instagram and TikTok. Start following us there, right?
Yeah.
You'll follow us for 2 weeks. And you'll get an idea if you like me, if you don't. My whole team is like me, right? So if you don't like me, you're not gonna like any of us. So don't do anything there. But then
There you
there's
go.
a bio. There's a link in the bio. Click the link in the bio. Fill out the intake form, which will take 30 seconds. We'll set up a call one-on-one, and we'll talk through what your situation is and what we might be able to do to help marriage together that situation and what we do at Life Goal.
Yeah. Again, give him a chance. Follow him on Instagram. I can't believe you're so consistent in putting out 1 minute educational videos. That's hard to do. So kudos to you.
Sometimes I feel like ramming my head through the wall, to be honest, with an everyday thing. But the reality is, too, I'm more in tune like you do. You do financial economic data every single day. There really
Yep.
isn't a topic someone can bring up to you where you're like, "Ugh, I'm lost."
Yeah,
Right?
I didn't hear that one. Yeah. Yeah.
Yeah. So it's cool. It keeps you on the ball.
There you go. Well, I want to talk about something that I am legit nervous about, but honestly, I don't know if I should be. And that is, we started a rate cutting cycle. I have very few memories of being young, but one of the most painful memories was 1981 when we almost lost our family home. We were a weekend away from losing it. And 1981 was that second bout of inflation. My dad was unemployed, I think, for 9 or 12 months or something horrible. Um, I'm legit concerned, PTSD perhaps. Given that we're on a rate cutting cycle, how concerned should I be about inflation reigniting?
So one of the things they talk about a lot is forward inflation expectations being anchored. And now, granted, they were anchored throughout the entire post-COVID period. So take it with a grain of salt. But I do think what that does is broaden out a lens. And I do think that smart money does legitimately get scared, which sets those forward expectations. So essentially, let me break this down a little further. There are instruments that you can look at in the market that look out 5 years, 10 years,
Mhm.
15 years. And based on the way people are buying and selling certain things, they can derive from that what the expectation the market is for inflation 5 and 10 years out.
Sure.
And that has remained relatively tamed all throughout COVID. And so you look at it and say, all right, maybe they were wrong, right? But now, if you zoom out 5 years, right? You zoom out 5 years right now, we're right prior to COVID. And
Okay.
you said, hey, inflation expectations are anchored at 5 year point from now. Yes, we had this massive spike in between, but inflation is relatively tame right now,
Are you
right? In a
telling me
future
inflation was transitory? Is that what you just
I'm
told me?
I'm telling you, inflation was transitory. Now, the transit period, did it take 1 year? Did it take 4 years? Right? So, but at the end of the day, I think it is an important metric to understand
Okay.
because when you're on the other side of it, right? If you're in a deflationary, it's easier to describe the perils of a deflationary environment because when people expect things to cost less in the future, they sit on their hands, right? And so that's not necessarily a good thing either. So if the market expected, inflationary pressures to pick up and to persist into the future, you would be able to see it in the way assets are priced. And the forward inflation expectations 5 and 10 years out would bake in a higher inflationary pressure than what we're seeing right now.
I don't think
Let
my
me let me let me, let
PTS.
me say one more thing too. Listen to all the shit that's happened in the world in the past 2 years that were black swan punch in the back of the head. You don't see it
Yeah.
coming type events.
Okay.
Whether it's Russia and Ukraine, whether it's Israel, Hamas, Iran, whatever it is, all of those conflicts that have popped up are all inflationary pressures, right?
Yeah.
And we've still held it together and been able to maintain a
Okay.
relatively subdued inflationary environment.
All right, I'll give you that. So again, we now I know what to look for and watch, which I will do. Again, PTSD doesn't allow me to walk away that quickly, but it's a concern of mine. But that said, you know this, but for the audience, there is two types of inflation. There's consumer inflation and there's asset inflation.
Mhm.
I think what you're talking about here and have answered so well is the first, consumer inflation. What about asset inflation? Could the lowering of rates being dry powder off the table and see asset inflation?
Oh, it absolutely could, because right now we sit at, I believe the most recent number I saw is $6.4 trillion in money markets.
I saw that too. Yeah.
And so if you're sitting at 6.4 a trillion, trillion, Tower, Thomas, Taylor,
Right.
trillion,
Right.
that's the number that's sitting in money markets right now. If that does get flushed, a portion of it, doesn't have to be all of it, gets flushed from there out into the market, it can certainly inflate asset prices one direction or the other. And I say to people like, listen, here's cash on one side of the spectrum. Here's stocks on the other side of the spectrum. So they're sitting in cash, money markets are cash. Likely, I think what happens is cash doesn't go from one spectrum of risk all the way out to the other. I
Okay.
think probably what happens is it moves to the next iteration of risk, which is somewhere in the bond market. And
Mm.
I think that some of that's getting priced already. You're seeing bonds rally and have seen bonds rally over the last 2, 3 months with the anticipation of interest rates coming down and therefore money market yields getting beaten up. As interest rates come down, people buy up bonds, forcing the price higher. And we've seen that.
So one of the things that you would have access to that ordinary mortals like I don't have to is flows. So I
Mhm.
know bonds are up. We can see that. But what about the flows? Have you already seen some flows disproportionately into bonds and money market flows down? I think money markets peaked at 6.9 trillion.
Yep.
Um,
Yep. Yeah, you've
so
seen massive inflows into bonds.
okay.
Like people
So you
aren't the
have.
market's not stupid, right? They know, okay, the Fed's telling us they're going to cut rates.
Yeah.
Whether they can or not, we'll see. But if they're going to cut rates, I want to sit in the most directly impacted in a positive way area of the market. And that
Yeah.
is bonds.
It's kind of an easy trade, right? I forget who it was, but over the weekend I read an article, someone calling it the golden era of bonds. Basically, the Fed has told you they're going to be cutting, so jump into a bond, and then as rates fall, the value of the bond goes up. It's kind of like toy.
This doesn't take a rocket scientist.
Yeah,
Listen, I've been telling people to get on cash all year. They don't listen.
yeah, it's crazy. It's crazy.
but
So,
but so let me break down, because again, I think this is one of the things that um, people like about what we do is break things down.
yep.
So think about owning a bond right
Mhm.
now that yields 4.5%.
Sure.
Okay. If the Federal Reserve is going to now reduce interest rates and that new bond, same vintage, same credit quality, is going to come to market at 3.5%. What happens is people just go out and they go, I'll buy this.
Yeah.
And they force the yield down to 3.5 to match the new coming out bond, and the
Right.
price goes higher. So
Correct.
it's just all an opportunity cost thing. Just to understand why there's that inverse relationship between interest rates and bond prices.
So one of the things that I think Powell is doing, and we've talked about this over a year ago, actually 2 years ago, the Jackson Hole meeting. I remember you and I having this conversation. Powell was only interested in his reputation. He didn't want to be reelected or nominated or whatever. This is his last term as Fed president. I do think he's battling not to be Arthur Burns. He wants to be considered Paul Volcker. Where do you think he is on that track? Is he right now set up to maybe engineer this mythical soft landing and thread the needle? Is he set up to be Arthur Burns because he's not looking at the not looking at the complete picture?
So I think I'll take a neither answer to that.
Ooh, okay.
Meaning, I don't think he's cutting too soon where inflation's going to reverberate back upwards. But I think the immaculate soft landing is pie in the sky. I understand that is what every major firm is saying is going to play out right now.
Mhm.
Every bit of historical data says that's not going to play out. Says that's the anomaly, not the base case.
Yeah,
Can it
90,
happen?
like one example, 94.
Like, can it happen? Yeah, absolutely. But by the way, in 2007, in 99, everyone was talking soft landing as well. This is not something where we're
Yeah.
always optimistic until reality slaps us directly in the face. And they don't announce a recession until generally 6-ish months until after it happens.
Yeah.
So the reality there is I don't think And by the way, we are not in a 1970s style environment. And the reason we're not in the 1970s style environment is because of the ingenuity of the US capitalistic market. And so if you rewind back to 1970s, a lot of what caused that massive inflationary pressure was the oil embargo that took place.
Yep.
And so we actually did something really similar just recently to what caused this run afoul of what happened in the 1970s. So we took Israel's side in a conflict
Mhm.
against an Arab nation. And we did that in the 1970s. And the Saudis stepped in and said, screw you guys. We're not delivering oil to the US anymore.
Yep.
And at the time, we were completely dependent upon external oil sources. And it was also a much bigger component of our overall economy. You had to drive to work. You had to use oil. Things were less oil efficient, et cetera. But now we are a net exporter of oil. So if they were to cut us off, which they haven't, right? And they're not going to, if they were to cut us off, I'm not saying oil prices wouldn't go up. They certainly would.
Oh
But we
yeah.
wouldn't have this
Yeah.
4x oil price like we saw in 1 year in the 1970s.
Yeah.
So we're not in the
James,
same environment, I guess is the point.
Jamie Dimon's been out and about talking about something worse than a recession. I actually agree with him. This is worse than a recession. And of course, he is highlighting that the US economy is at risk of stagflation. Why don't you first define for us what stagflation is, why it's worse than a recession, and talk about the possibilities?
Yeah. Stagflation is just the complementary presence, or compliment sounds like a good thing. It's not a good thing.
Not good.
I'll still stick with the word, the complementary presence of high inflation coupled with low growth. So whatever the opposite of a compliment is, that is what it is. It's a
Yeah.
recipe of disaster. But yeah, so why is that more impactful? Inflation in general is a bigger problem than a recession because inflation impacts 100% of the population.
Correct.
A recession might lay off an additional 3, 4, 5%, and therefore it impacts that amount. But inflation literally impacts all. And
Mhm.
we have social safety nets to deal with recessions and unemployment. We don't have social safety nets to deal with the entirety of an economy, population dealing with massive inflationary pressures. So if you get a stagflationary pressure, where not only does inflation pick up, but the economy starts to fade some, that's like the worst of both worlds. So that is definitely an issue that needs to be present and accounted for. I don't see the inflationary problem rearing in the
Yeah.
data.
Yeah, stagflation, what I've always said is that, we've always talked about the Fed tools being kind of blunt instruments. What I've always highlighted when I talk about stagflation being horrific and like the worst possible outcome is their tools can only fix one or the other. Either the
Right,
tools can battle inflation or they can battle slow growth. They d-
right.
they're kind of like on the opposite end, right? If you have both situations,
Yep, totally.
yeah, totally.
But you'll like this, and your audience will like this. What was the second best asset class to oil in performance, real return performance throughout the decade of the 1970s?
Oh, real estate, absolutely. Yeah.
There you go.
There you go. There you go. Well, one of the things that I was on early, and I actually still feel pretty good about this, is I think in historic context, it probably won't be announced till next summer. It's always delayed. Is we are going to hear about the first rolling recession. I think we are in a rolling recession. My greatest example for you, Taylor, would be the mortgage industry. The mortgage industry has gone through a bloodletting. There's something like 50 or 60% less people in the mortgage industry. But here recently in the last 6 weeks, I called for and we got a refi boom. I think lower rates have already brought some people off the sidelines and could bring more. So I think what's going to be looked at here is we're going to have our first possibly 6, 8 quarter rolling recession where we won't have this .com. We won't have this great recession all over a cliff at the same time. What do you think about a rolling recession?
Fair, fair. I think that, we saw it in housing and the construction side early. We saw it in the mortgage side early. We're seeing it now in discretionary spending and things like Harleys, RVs, et cetera. We have a CEO. I'm sorry. We have an owner of a Harley dealership as a client of ours, and he said And he said there's been some missteps on the corporate front as well. But he said
Yeah.
all in all, it's been really, really, really tough. We also have a yacht salesman as a client, and he said the same thing. It's been really, really tough. And these are people that he said yachts generally aren't financed either.
Yeah. They're just
So,
cash. Yeah.
but the financing cost certainly hurts. It definitely hurts the Harley dealer. But yeah, I could see that playing out. That wouldn't shock me whatsoever. I think it's all broadening out and saying, okay, listen, how does the overall economic backdrop look? Like, yes, we are going to be experiencing pain in certain subsectors of the market and already have. How does that impact the broader mentality of the broader economy, but also the broader consumer? I think is really the concern.
Yeah. I heard yesterday from my stock friend, Mr. Dan Bird, that we have just now started the worst week in the worst month of the year for the stock market. Historically speaking, this 7 days after option expiration is the worst week of the year in the worst month. Um, what do you think's going on in the stock market? Near as I can tell, we're at or near all-time highs. We got the Fed cutting rates. I mean, could we go markedly higher? Or are we going to chop sideways into an election? I mean, it's kind of wild out there.
It is, and you look at the different asset classes. It's really funny, and try to kind of pick apart at what's going on here. You see stocks right now. The easiest way to say is the stock market enthusiastic or are they scared is
Mhm.
by looking at the price to earnings ratio.
Yep.
And so for those that don't know, it's literally it just takes every dollar worth of earning a company or the broad S&P 500 makes and how much is the price right now. So every $1 worth of earnings right now the market is paying $21.2 for that $1 worth of earnings.
Hmm.
That puts in the top 4 percentile of most expensive stocks have been throughout
The top
history.
4.
Top 4, right?
Wow.
So if you were to tell me, hey, what does the economy have to look like in order for stocks to be priced in the top 4 percentile? I would have to say, like, we are early to mid cycle and the economy is going to absolutely rip from here in order for that to make sense. I don't necessarily see that being the case. And when you look at the other side of the ledger, whether it's again gold at all time highs, that's a
Yeah,
fear trade.
that is.
Bond yields coming crashing down. That's a fear trade. You look at commodities falling off a cliff. That's a fear trade. And so I don't know that the economy continues to meaningfully deteriorate, but regardless whether it meaningfully deteriorates or not, stocks are priced for absolute pie in the sky right now.
Yeah, perfection, perfection. One of the things that I am looking at, because again, one of the things that I talked about early with Lance Lambert, again, this is about builders, was rates were ripped so high and so quickly that we basically killed mom and pop builders. Said another way, anybody but the top 10 couldn't afford to build anymore, right? They couldn't
Yep.
run operations. They may not even have got the lending approved, let alone be able to, pull the 9 or 10 or 11% construction loan. But where I'm going with this in the stock world is as rates come down, the Mag 7, they don't really borrow, right? They got
Correct.
stock, they got all that. They got cash, they don't really
Yep.
care. But
Yep.
as rates come in, where that will impact the most is the Russell 2000. The Russell
Correct.
2000 does have variable rate debt versus fixed rate debt, generally
Correct.
speaking, if you look at their balance sheets and their liabilities. Um, I'm asking myself, when do these small and medium-sized business start to deploy capital to buy in inventory, capital investments, acquisitions? I mean, I don't know that a half a point does it, but if we are on a meaningful rate cutting cycle, could we see the small and medium-sized business who have essentially been out of the market since Jackson Hole, will they start tiptoeing back in? What do you think?
I think what's interesting right now is you have this cross current playing out when it comes to Russell 2000. So Russell 2000 are companies generally sub $5 billion in market cap ballpark.
Generally, yeah.
So what you have is this positive pressure coming from lower interest rates. So when they go to a bank, they're going to get it at a lower rate. But you also have the negative pressure on the other side of the market saying, okay, the Fed doesn't cut for no reason, right?
Mhm.
Although the broad stock market right now is saying that, but reality and history says that that's not necessarily the case. So you aren't getting this meaningful pump that sits and stays in the small cap space. When you get reprieve on interest rates, small caps have rallied for short periods of time, but you have not gotten this massive early to mid cycle yank higher in small caps. And so it'll be interesting to watch that play out. But yeah, to your point, if they can continue to finance at lower and lower rates, then they can go out and continue to build their business. The question is are they confident in the economic backdrop that allows them to take the risk to take on a loan at 6-7% to go out and try to drive profits with that as their bogey that they have to increase on top of?
Yeah. The last thing we'll talk about here as we wrap up, because I know you got a hard stop here in about 7 or 8 minutes, is the presidential election. And we're not talking who you're voting for or any of that. I'm just saying, I think this election is the first one as an adult for me. All right. And I'm older than you, that I am actually seeing meaningful consumers pull back. I'm scared. I'm nervous. I'm pissed off. I'm afraid, whatever that is. And I obviously look a lot in housing. I'm seeing demand pull back. It's called marginal demand. I am curious if marginal demand is being pulled back in other areas, like small business, like people investing, getting out of the money market. And the interesting thing about, if I'm right about marginal demand, is it's like pressure on a hose, right? If you were a kid and you ever held your finger on the end of a hose, it's pretty easy at the beginning, but as pressure builds, good luck holding that for very long. So I'm curious, in your world, do you see marginal demand being compressed, held back? And then do you think it unleashes in 2025?
Yeah, I think both from an asset price perspective of people going, "Hey, I'm not investing before the
Yeah.
election plays
I'm
out."
out. I'm just out.
Yep,
I'm out.
yep, and they're scared to death of one side versus the other. Trump's a lunatic, he can do whatever. On the other side, you're a socialist, Kamala. Like there's gripes on both sides, and half the aisle thinks the one's an absolute more. Actually, I think three-quarters of the aisle think both are morons.
Both
But
of
and
them. Yeah.
I tend to fall in that camp for the record. But nonetheless, you get the point. And but they're really particularly scared about one side or the other winning. And so with that, I think people are absolutely sitting on their hands.
They're
And I
sitting
heard
out.
that exact comment that you just made from one of the gentlemen I just spoke to that sells a consumer good. That's
Yeah.
a relatively meaningful chunk of money for people, not a home by any means, but
Yeah.
$15,000-$20,000. He's like, it's politics. And I'm like,
Yeah.
it's funny that I see it from an investment standpoint because people are
Yeah.
scared, but from a recreational product standpoint, politics
Yeah.
is driving it.
Yeah, pretty crazy. Well, we do got time for one more topic. I wanted to hit this banking crisis 2.0. I did see a report that Q2 unrealized gains in the bank, unrealized losses is now roughly 513 billion. Bank of America sitting on roughly 20% of that, 110. FDIC problem bank list now stands at 66. Obviously, probably very small banks. But what do you think the chances are we ignite, Silicon Valley Bank, First Republic 2.0 sometime in the near future?
Doesn't matter. The federal government's going to step in. We saw it. We saw it, right? The
Bank
Fed
term
stepped in.
funding program. Yeah.
That's it. And it would happen, right? If it was, I mean, I'm not saying that two small banks can't fall off the map. They certainly
No,
could.
clearly.
They'll
Yeah.
try to organize a buyout like they did in the last round of things, but you're not going to see biggies. I think biggies are well capitalized, which is why their stock prices have done just fine. I think it's all. I don't know the context of it. I think it's all a percentage of that needs to be
Yeah.
stated. Like people say $20 billion or $50 billion. And it's like, okay, let's put some context around the
Yeah.
outside. I think we're all right.
Yeah. The
And,
one
and
thing that
rates are coming down, by the way. So that's only going to help.
Yeah, the one thing that it's funny you bring that up. The one thing I had a conversation with one of my other experts was how it, could the Fed be thinking about fixing the banking crisis before it happened? And the answer is yeah. If this unrealized loss, 513 billion, is a lot of multifamily and commercial, the Fed doesn't have to lower rates that much because rates will directly impact cap rates,
Yep.
right? And if you can get cap rates to fall a little bit, banks are being made whole like that.
Yep.
We did some math on a fictitious building, and they only had to get cap rates down 0.5%, and the bank was whole. Um, so again, I think these unrealized losses, when the Fed's cutting rates 200 basis points, will fix itself by the summer in a large margin.
One of the things, maybe the last thing I'll say here is the counterpunch of my concern about long and variable lags not being quick enough, when they cut rates is the market's pricing it ahead of time, right? So the market's pricing in ahead of time the Fed moving. And so you are getting financial easing more quickly than the Fed's ability to actually cut.
Yeah. Taylor, you are amazing. Thank you for being here every month for us. Again, one more time, where could they follow you, schedule a call, all that stuff?
Yeah, follow us at Life Goal Investments. Where I'm both Instagram and on TikTok. And after following for a couple weeks, you'll know again whether you like our style and what we talk about. Click the link, and if you don't click the link. Right, click the link in our bio and log right through to a submission page that'll have you say, hey, I want to do a call, and it'll be directly with me. By the way,
Yeah. Portfolio construction. Tell him you came from one rental at a time, just so he knows his time is worthwhile. Buddy, I
for
appreciate
sure.
you. Take care.
You're the man, Michael. Thank you.
Later.